One of the things that'll help you set up a successful trading strategy is pattern recognition. Now, this is something that takes some skill and practice, but let me show you some pattern recognition, how this works, okay? So this is Netflix going back to October 9th, 2017, and the whole trading day goes from here up until the next day, which is right here. So this whole area is one day, and each candle is 5 minutes. Okay, so I notice here that on the first candle on October 9th, that they gapped up Netflix and brought it right down. All the way to here, it bounced up, and then it came back down. That's really choppy and really fast trading, which is why I recommend not to trade the first 15 minutes of trading. But at least you can see that what they're doing, and you can watch for it in the future. So they gapped it up and they brought it down. Let's go on and see what happened over here in the beginning of the next day. They did the exact same thing again. They gapped it up to here. So here's the closing price of the previous day right here. The next day, they gapped it up to here. That's the open. It went up briefly within the first 5 minutes and then started down. So about 10 to 15 minutes into the trading day, right about here is where I'd look to sell short this stock. And you can see that although it bounced around, I would have either gotten out right there, or depending on my profit target and my risk parameters, I might have stayed in and got in, covered down here somewhere or over here maybe. I'm not sure, but I would have made a nice profit on this trade. And it would have been about 197 down to about 196 or even 195. So $1 to $2 profit on the trade. Very nice. All right. So we see it happened there. Let's see going forward what happened. The next day, the 11th, well, they did it again, but it didn't last. It was just a one candle. They gapped it up and brought it down, and then it just chopped for a while. So not a good trading day for that pattern. Let's look at it here. They gapped it up. It bounced around. It climbed to a newer high at 10 o'clock. And then finally, it had a steady sell-off. So that didn't pan out quite as nicely, but we still see them gapping up and then selling off at some point during the day. It's kind of interesting. Here is a better example right here. They gapped it up, and it's not clear what's going on for the first 10 minutes of trading. Finally, right about in here, maybe in here, I probably would have sold it short with a tight stop. So I might have entered right around 199.50 with a stop at 75, maybe, something like that. Let's get rid of that. Okay, and then it came all the way down to here, which is 197.50. So this was about $200 a share there. So about a $2 to $2.50 profit on that trade. Let's see this moving forward. Okay, they did it again. Gapped it up. It bounced. So you got to be careful about that. But I probably would have sold it short right around in here. And then it comes back down. Now, something that you need to watch for when you see this, where the trend is developing and then it pops up. If I wasn't out on that candle, I definitely would have been out by that candle when it makes a higher high. That's a pretty good signal that your downtrend is over, and definitely you want to be out by that time. We want to take a good steady profit, a sure thing, and then get out. That's our purpose. We don't want to hold on too long, and that's something that new traders often do. So lock in your profits, ring the cash register, as they say, and don't give it back. When you make a profit, don't give it back to the market, because you could have got in it right here and held on all day, and then by the end of the day, you turned a nice profit into a big loss. Don't do that. That's a guarantee to lose money. So let's look at the next trade. Well, they did it the opposite way, this way. What they did was they gapped it down, came down quickly to this price, and then they brought it back up quickly. So that could have been a nice trade if you had caught that. And then it sold off again. So you can see that they're kind of using variations of the same method of gapping it up and down, and then sometimes there's a move that you can catch right after the gap, and sometimes you have to wait a while for it. So if you didn't catch it down here, you could see it fail right up about here and sell it short right about there and caught a nice trade. Okay, and then you get out when you see that the down move is over, right around in here somewhere. Okay. As you go, you can see this pattern happening over and over and over with NFLX. On the 18th, it did it. It opened and just went straight down. Okay, let's go to the 19th. It gapped down, it went down a little bit, and then about 10 o'clock, it went up for most of the rest of the day. Okay, closed at the high. Interesting. Right here, did it again, gapped up and went down. Let's look at the 23rd. It opened about the same price. There's no gap there, but it did go straight down and then had a reversal right around 10 o'clock. Okay. So we see a lot of gap moves that would have been good trades on this stock. Now here's one that didn't quite follow the pattern. It gapped up, it came down, and then within 10 minutes it's starting to trend up again. So nothing happens for sure all the time, every time. That's what makes the stock market so tricky. But when you do see this pattern, you can make money off it. And this is a pattern that recurs all the time, and this is something, especially when you see them doing it on a stock, you can look for it on that stock. And this isn't the only pattern that you can use. There's lots and lots of patterns. Go look for them. So this is how you use chart recognition to improve your trading. So let's look at another way that you can use to find good trading strategies. And you'll see that in the next video.